At this point, I think that has to be taken off the table, and the market's just completely repriced. Now, I think the market went from one extreme, being very bearish, to being almost overly bullish, and in part because it seems like positioning was all very one way. People were in yield curve flatteners and also short the front end, and that's probably taken down the other way, where a lot of people are now probably long or at least flat the front end of the market. So I think at some point we'll settle down here and get a little bit of a pullback, but not while we're in the midst of large international banks having to be bailed out by regulators.
I want to go back to where you were talking about this dramatic steepening of the yield curve. How much of this was really driven by short covering?
Yeah, we think quite a lot of it. Unfortunately, some of the data is not overly available, and you even have it worse because there was an issue with some of the data that was released out of the Commitment of Traders report from the CFTC. So we don't even know the futures positioning up to date. They only have that data through February 28th. So we don't even know what that was like last week. But it definitely feels, and just speaking with a number of investors and our clients as well as trading desks, it does seem a lot of this was position squaring, people getting flat, and people just taking a lot less risk and reducing their exposure. The flattening trade getting to negative 100 basis points on the 2s, 10s, for example, that was kind of, I think, an important psychological target. And once we got there, some people were very ready to pull the trigger because they were also very positive in those trades. They had made a lot of money over the first couple of months of the year being in flattening positions. So this steepening is not a huge surprise.
Ira, do you think in terms of a 5% on the 2-year, we're done with that in this cycle?
I'm sorry, my earpiece came out. Can you ask that once again?
Absolutely. A 2-year note at 5%, right? It was above that last week. Are we kind of done with that level in this cycle?
Yeah, I think we might be. 480 was the level that we had tagged as kind of the peak in yield, and that gets you a Fed funds rate of around 5.25%, and then the Fed on hold for the better part of a year, and then cutting interest rates. So I think getting back up to 5, that's an extreme case. I think you would need to get financial stability and kind of this fear that the financial sector isn't broken out of the way very soon in order to get a resumption of the idea that the Fed's going to hike above 5.25%, 5.5%. So I do think that we're not likely to see that. Now, could we pull back to 4.25%, 4.5% again? Yeah, I think that's completely possible. And that's an environment, like I just mentioned, where the Fed hikes to 5.25%, and then stays there for the rest of the year. And I think in that environment, you get to that 4.5 kind of Fed funds rate, but not much higher than that.
Carol earlier brought up the balance sheet. What do you think this means, Ira, as far as if you have the Fed potentially, if they do pause rates, what does that mean in the background if they still have that issue with the balance sheet? Is that still essentially tightening?
Yeah, I think it is. I think they'll try to continue to reduce the size of the balance sheet just because they think that it's much larger than it needs to be. It's very large as a share of the economy. Typically, and I was just looking at this with my associate Will Hoffman today, that the balance sheet is much larger as a share of the economy than it usually is. Usually, the Fed owns around 17% of the Treasury market. That's on average, and now they're upwards of 21%. So trying to shrink their balance sheet back to quote unquote normal conditions is, I still think, a policy goal. And I think it's much more likely that they pause, continue to run off the balance sheet at least for a little while, and then reassess if there continues to be these financial challenges. Now that doesn't mean that the Federal Reserve won't offer funding to financial institutions as the lender of last resort. They absolutely will, but at the same time, they think that they don't necessarily need to own treasuries. And given the demand of treasuries the last couple of weeks, there's not going to be any problem with the Treasury Department issuing more bonds over the next couple of weeks at least.
We are definitely living in fascinating times. Ira, thank you so much. Ira Jersey, Chief U.S. Interest Rate Strategist here at Bloomberg Intelligence. Really always a must-read when it comes to what's going on in the rates market. Joining us from our BI Bureau in Princeton, New Jersey. Fascinating.
It really is, and it makes me think of, especially you bringing up that great point about the balance sheet, reminiscent of what we saw in fall of 2018, Carol, right before we saw that big sell-off that year.
No, it's you think about the Fed, right, and what it's dealing with, and rolling off those assets on the balance sheet. That is certainly impacting, tightness, certainly
Right.
when it comes to the environment. All right, everybody, let's get back to world and national news. Off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. Moscow says it will try to retrieve the wreckage of a U.S. surveillance drone that crashed into the Black Sea yesterday after a collision with a Russian fighter jet. Meanwhile, U.S. Defense Secretary Lloyd Austin says he's spoken with his Russian counterpart and told him the incident will not deter the U.S. continuing those flights.
As I've said repeatedly, it's important that great powers be models of transparency and communication. And the United States will continue to fly and to operate wherever international law allows. And it is incumbent upon Russia to operate its military aircraft in a safe and professional manner.
Austin spoke after holding a virtual meeting of the Ukraine Defense Contact Group. He says Russia is running out of capability and running out of friends after taking down that drone. Some lawmakers in Congress are calling for a return to tighter banking regulations after the recent failures of Silicon Valley Bank and Signature Bank. Federal regulators had to step in and ensure depositors would have access to their money. But lawmakers like Senator Elizabeth Warren say a rollback of some Dodd-Frank regulations back in 2018 led to the bank's collapse. She says it's time to go back and fix the threat. Longtime Green Bay Packers quarterback Aaron Rodgers says his intention now is to play next year for the New York Jets.
Because I still have that fire and I want to play and I would like to play in New York. It's just a matter of getting that done at this point.
His comments came during an appearance on the Pat McAfee Show on YouTube and SiriusXM. He says the Packers are still working out what their compensation would be for the trade. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And we check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. 4:40 past the hour now. A lot of drama on Wall Street today, but after all that drama, stocks managed to finish mixed. The Swiss National Bank to the rescue. After Credit Suisse shares plunged earlier, its top investor said it wouldn't buy more shares. That triggered the sell-off, and it got pretty bad for a while. Even some signs of chaos in the swaps market. But Bob Michael, CIO and global head of fixed income at JP Morgan Asset Management, says Credit Suisse shows the lagging impact of central bank tightening is really catching up with us, and he says watch for more.
If you think about where we were a year ago, the Fed was just starting its rate hiking cycle. So over the next couple quarters, you're going to get those long and variable cumulative and lagged impacts hitting the market further. So I think this is the tip of the iceberg. I think there's a lot more consolidation, a lot more pain yet to come.
And all this has some speculating that we could even be on the cusp of a recession. And of course, that is all triggering hope that the Fed might lay off the interest rate hikes. The Dow closing down 281 points, the S&P 500 down 27, the NASDAQ up 6, as I mentioned. Yield on the 10-year right now, 3.46%. We were at 3.39 earlier today. NYMEX crude, it's down 4.3%. Spot gold up about 0.7%. Adobe shares higher. Adobe boosting its earnings forecast for the year, and that signals demand for creative software remains resilient. And that is a Bloomberg Business Flash.
All right, Denise, thank you so much. Carol Master along with Jess Menton live here in our Bloomberg Interactive Brokers studio, streaming on Bloomberg Originals and, of course, on YouTube. Want to get to our next guest. You know the backdrop, global markets on edge, fresh turmoil at Credit Suisse. Just a few days after the collapse of some American regional banks spurred a frantic rush for cover. You've got the Fed working with the Treasury to review U.S. financial sector's exposure to Credit Suisse. And then we've seen a real repricing when it comes to expectations on the Fed. So jam-packed day. Great to have back with us Peter Atwater, adjunct professor of economics at William & Mary, former Wall Streeter, someone who really so smartly connects Wall Street and Main Street and Washington. He is the person who coined the term K-shaped economy, and he's a financial historian, and he is joining us via Zoom in Pennsylvania. Peter, good to have you here with Jess and myself. I got to first ask you, if you were still on Wall Street, would you be hunkering down and moving assets into safe havens because you thought, okay, there's more to this crisis than we've seen so far? And I shouldn't use crisis, I think, actually. It's 3 banks that have gone down. Credit Suisse has had problems for a long time, so I've got to be careful in what I say.
Yeah, I think we're in the midst of a panic. And so I think that's a good term because it describes the environment in terms, at least in terms of confidence in the way people feel. You know, I think everybody is hunkering down. It's a natural response to our low confidence. So I expect that every firm on Wall Street, if not regional banks and global banks right now, are looking at all their risk positions. It's a natural, impulsive, emotional response to what we've seen.
Peter, you mentioned the environment. How important is it for us to really understand how did we get here?
So it's critically important because the backdrop of confidence really drives what we do. And I think underappreciated, particularly for the last 6 or 9 months, has been the fact that at least American confidence, if not global confidence, has been really low. And when that happens, we are predisposed to act impulsively, dramatically. If you look at history, these are the times when banks fail. You know, bank runs don't happen when everybody is confident. They only happen when people feel powerless and uncertain. And that's what this sort of environment is fostering.
Is a lot of it, too, that we've just quickly moved from, it feels like, a very low rate, negative rate environment, easy money, liquid environment. How many adjectives can I use here, Peter? To a very different environment where we're tightening as the Fed moves to rein in inflation.
Yeah, I would frame it a little differently. I think we went from extreme confidence in fixed income, reflected in the trillions of dollars of negative interest rates. So we had that peaking at the same time that we had all of this abstraction, NFTs, crypto, all the different coins and SPACs. And so what I think we're seeing here is a collision in the falling confidence, not only in terms of abstraction and what we've seen in the equity market, but the same decline in confidence that's hitting us in fixed income. And so those two really came together at Silicon Valley, where you had this double whammy of people fearful of the crypto connection as well as the bond connection.
You talked about how this is a panic, and I want to know more specifically, why do you think this is a panic this time around versus people who are arguing, well, this is more if you're looking at the types of mid-sized banks that had these exposures specifically towards deposits?
Because I'm looking at the behavior. And so the behavior reflects panic, which is that movement that we have as our sense of powerlessness and uncertainty swell. And that happens generally towards lows in confidence. And panic, if you think about it, if you've ever experienced a panic attack, what that is anticipatory. It's an extrapolation of the trend. And so that's what we're seeing here at lows and with this low in confidence is people are extrapolating the fact that one bank has gone bad, therefore others will occur. And that's the nature of this panic contagion that you see throughout history.
Totally get that. And this is part of what we were talking earlier about psychology and how, versus fundamentals, but how psychology can drastically change fundamentals that can really play out. Having said that, Peter, Bill Isaac, former head of the FDIC, there in the late 70s and 80s, saw a lot of bank problems, said, looking at Silicon Valley Bank, this is a bank whose, balance sheet just exploded in terms of assets. So it makes me wonder, where is the regulatory oversight? What are we missing in either shadow banking or the private markets that I feel like there isn't that much transparency over?
So I think as with everything, when confidence soars the way it did certainly in financial services up until a year or two ago, you see the regulatory environment follow suit. So regulation naturally becomes more lax before confidence turns down. And sadly, this is a phenomenon that we see again, repeated in history. And so you're seeing regulators now playing catch up. And what we'll see is once the barn door is, the animals are out, they will once again close the barn door after them.
Are there more animals to come out? Pigs can move kind of fast, cows can move kind of slowly. You know what I mean, though. But should we expect that there's more to happen here?
So I think we have to watch how people are behaving, because if mood continues to deteriorate, there will be more contagion. Things will move more quickly, more widespread. If this was the bottom in terms of some sort of capitulation, then we should see confidence begin to rebound. But I think we need to be cognizant of the fact that after a traumatic event like this, we continue to be hypervigilant. And so we have to be careful that we don't have this false start and then roll over again.
Carol mentioned earlier about how you popularized this term, the K-shaped recovery. What are we in store moving forward? What kind of shape here are we talking about?
Well, I actually think what we're witnessing is a lot of confidence at the very high end that preceding this was extraordinarily confident is receding. And so I'm seeing this beginning of this closing of some sort of a alligator jaw where those at the top moved substantially higher and they're starting to move down. And remember, for those at the bottom, this continues to be an extremely difficult environment because of inflation, because of particularly food and energy, and certainly housing and cars.
Just got about 20 seconds, Peter. Your thoughts on what the Fed needs to do next week?
I think the Fed has done a remarkable job this past weekend in terms of trying to instill confidence in the system. As far as what they do next week, I'm watching the T-bill market, because the T-bill market is going to lead the Fed into where they position themselves. I think they have to be very conscious of not unsettling things and making investors feel more powerless and uncertain than they feel today.
This was so great. Peter, thank you so much. Really appreciate you joining us on this Wednesday. Peter Atwater, he's adjunct professor of economics over at William & Mary, joining us via Zoom from Pennsylvania. As you said, Jess, person who coined the term K-shaped economy, but really this great intersection of having understand Wall Street and been in it, and then kind of where he is right now.
It's fascinating, and especially like he was pointing to, watching the T-bill market for those cues.
Right?
Right.
We're all watching it so closely. All right, Carol Master along with Jess Metton.
Connection lost.
This is Bloomberg Radio.
your company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters, I'm Denise Pellegrini. We're keeping a close eye on shares of Adobe. They are solidly higher. Adobe boosting its earnings forecast for the year, signaling demand for creative software remains resilient. Profit $15.30 to $15.60 a share, excluding some items, and the company saying that in a statement. Its previous range topped out at $15.45 a share. Credit Suisse shares plunging earlier. Investors on edge after its largest shareholder said it wouldn't inject more money in the stock. But now there is word that the Swiss National Bank will provide liquidity to Credit Suisse if necessary. And there could be some type of a spinoff or of the company, or sources say a tie-up with another bank. Diamond Sports files for Chapter 11, the game over for the nation's largest owner of regional sports networks. We get more from Bloomberg's Steve Rappaport.
Denise, Diamond Sports Group has filed for Chapter 11 protection, marking a swift downfall for the company owned by Sinclair Broadcast Group. Diamond Sports, operating under the Bally Sports brand, loaded up debt by gobbling up 21 regional sports networks from Disney for more than $9.5 billion. The increase in customers trading traditional cable TV for streaming services didn't exactly help either. The company says it has about $425 million in cash on hand and plans to eliminate about $8 billion of debt. Denise?
All right, thank you, Steve. And as I mentioned, we did see the problems for Credit Suisse and the tension around it sort of abate, but shares of First Republic got downgraded by the S&P, and that stock fell today. And those are the company stories we're following this hour. I'm Denise Pellegrini. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week. Carol Masser, as you know, Tim is on leave, Jess Menton with us, and we're going to get more Business Week in just a moment. But first up, we do want to get the latest world and national news. We've got Nancy Lyons standing by. She's in our 99.1 newsroom in Washington. Hi, Nance.
Thanks, Carol. The U.S. is promising to continue flying surveillance drones in international airspace over the Black Sea following yesterday's drone collision with a Russian jet. Defense Secretary Lloyd Austin called the incident unprofessional.
This hazardous episode is a part of a pattern of aggressive and risky and unsafe actions by Russian pilots in international airspace.
Russia's ambassador to the U.S. says he's hoping to maintain civil relationships with the U.S.
We don't want any confrontation between the United States and Russian Federation. We are in favor of pragmatic relations.
Russia's ambassador to the U.S., Anatoly Antonov. The Federal Aviation Administration today hosted a safety summit to address recent close calls at airports as well as other issues. Billy Nolan is acting FAA administrator.
In light of these recent close calls and the attention being focused on even the most routine of go-arounds, are we emphasizing efficiency over safety?
That's the FAA's Billy Nolan. Transportation Secretary Pete Buttigieg admits that there have been more mistakes than usual in U.S. air travel recently. The French Bulldog is now the nation's top dog, replacing the Labrador Retriever as the most prevalent purebred dog. The lab has been on top for 3 decades. Brandy Munden is Vice President of Communications for the American Kennel Club.
Honestly, the registrations went through the roof. I think the popularity has surged to the point where people are paying a lot of attention to it. The lab is traditionally, everybody's always going to love the lab. It is what it is. But when it comes to registrations, the Frenchies really pulled ahead.
Munden says out of more than 700,000 puppies and other dogs newly registered last year, 1 in 7 of them was a Frenchie. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Jess.
All right, Nance, thank you so much. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. In about 8 minutes, you can find out if your business qualifies for employee retention credit assistance. Innovation Refunds has helped thousands of small to medium-sized businesses claim the ERC and may be able to help yours as well. Time is running out, though, to claim the ERC, so get started today. To learn more, just head to getrefunds.com.
March is Women's History Month, and every day this month we are celebrating significant moments in women's history. Now, with your installment for this Wednesday, March 15th, 2023, here's Bloomberg's Lisa Mateo.
On this day in women's history in 1946, former First Lady Eleanor Roosevelt is appointed U.S. Representative to the United Nations by President Harry Truman. Roosevelt was just coming off her time as First Lady from 1933 to 1945. She served as the first chairperson of the Commission on Human Rights and was the driving force in drafting the Universal Declaration of Human Rights. Public service first became her passion after marrying then rising politician Franklin Delano Roosevelt in 1905. She was deeply involved in human rights and social justice issues, advocating equal rights for women, African Americans, and Depression-era workers. In 1968, she was posthumously awarded the United Nations Human Rights Prize. That's Today in Women's History. I'm Lisa Mateo, Bloomberg Radio.
All right, Lisa, thank you so much. Carol Massar along with Jess Metten live here on Bloomberg Business Week. Well, it's been quite a day. We've got Janet Yellen, I think, up on Capitol Hill doing some testimony tomorrow. It'll be interesting to see the tone of the markets, whether or not things settle down again, Jess.
And what's interesting, as we get toward the end of the week, Friday's actually triple witching. So we still have a lot of different events coming up. Also, there's those GICS changes when you're looking at some of the companies, whether you're looking at those that are moving from either the financial sector or the industrials, or even when you're thinking about Target, some of these dollar stores like Dollar Tree, moving from discretionary to staples, actually.
We talked about that a little bit earlier.
Yeah.
I'm looking at the most read. The top 11 stories are all about Credit Suisse in some way on the Bloomberg terminal. All right, you are listening and watching Bloomberg Radio.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
Hi, everyone. Bloomberg Business Week continuing on this busy Wednesday. We are live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Carol Massar, as you know, Tim, my co-host Tim Stenivek on leave. Jess Metten still staying with us. And coming up this hour, Jess, we're going to hear from former U.S. Treasury Secretary Larry Summers weighing in on today's market stress and global bank worries.
And also, even beyond what's been going on in the markets, we're going to take a look at how TikTok is considering splitting from its parent ByteDance, also looking at the most vulnerable and important profession in the U.S., Carol.
Yeah, this is really important, and we're going to kick it all off with a look at how the collapse of Silicon Valley Bank threatened an already fragile economy. We're in a tough spot, and it feels like we could go a couple different ways. All right, first up, though, let's get a check on that day's trade and top business stories. Here is Denise Pellegrini.
Yeah, thank you, Carol. Wild day in the markets today. 5:01 on Wall Street now. We checked the markets all day long for you, and we did manage to close mixed, but that was not looking like the case earlier. Swiss National Bank, though, riding to the rescue and saying it will provide liquidity to Credit Suisse. Shares earlier had plunged in Europe and also the ADRs here in the U.S. after Credit Suisse largest shareholders said, this is the Saudi National Bank, said it would not provide more cash injections. And Ariel Robini, chairman and CEO of Robini Macro Associates, among those sounding the alarm about Credit Suisse.
The SVP was only about $150 billion of assets, while in the case of Credit Suisse, we're speaking about at least $700 billion. So anything will happen to Credit Suisse will be of systemic effect for not just the European financial system, but also for the global financial system. So if Silicon Valley Bank create ripple effects in global financial market, something bad happening to Credit Suisse will be an order of magnitude more severe, something more like a Lehman moment.
But as I mentioned on the day, the Swiss National Bank is providing or promising to provide liquidity now to Credit Suisse. The Dow had been down hundreds of points